All right, Yield Nerds, episode 179. I am cooking 11 something percent returns, and I have a diversified equity portfolio that is beating NASDAQ using an algorithm. Details coming up shortly. We are up to 494 subscribers. Thank you for your support. We're coming up on 3 years of existence. I guess we just crossed 3 years of existence. Thank you. If you're new to this show, please use the income investing roadmap that organizes all the topics in chronological order. There are a handful of playlists that you can see as well. And before I go any further, I want to remind you that I do not have powers of prediction that are always accurate. I predict, but I'm wrong. So you have to do your homework as well. Well, four parts as always. We'll take a quick comparison of me versus the market and then review that yield curve that is still sleeping. And I'm cooking an algorithm. I'll show you where that algorithm is going and review my holdings. Hey, look at that. At per Schwab, I have a perfectly balanced portfolio. Maybe it's not perfect, but it doesn't say it's imbalanced. I'm a little bit heavyweight on industrials, shy on financials, but in everything else, I'm kind of sort of within rounding error of what Schwab recommends. As far as equity allocations, in the last 2 weeks or so, I appear to have gone from 4.1% to 4.4%, but that is not because I have allocated more cash to equity. That is because my equities have grown by whatever percent, 10 plus percent. So I'm having a good time using my algorithm. I'll tell you more about what it is and how it does here shortly. My returns for the last 3 months have been 10.6%. Now realize that that is 10.6% on give or take 4% of the portfolio. So not, an incredible thing to write home about, but hey, if you give me 10% returns, I will slowly increase allocation. On fixed income, I'm doing just fine. This is 96% of my allocation, which is clocking about 0.75% in the last month. So I'm happy with that as well. My asset allocation is a little bit conservative. Well, it's a whole lot conservative. I have 10% on agency bonds, 55% on treasuries, 10%, 20% on investment grade munis, and the last 9-ish% on corporate bonds, where I'm taking a very unusual strategy. I'll tell you more about that as well. So, I'm not heavy into equities. As you can see, this is about 4 something percent on equities, but I would say I'm solidly into municipal bonds, treasuries, agencies, and a little bit in corporate. Well, I keep saying the yield curve is sleepy. And before I go further and tell you why I believe it is sleepy, I need to remind you that I'm not a wealth management advisor. This is not investment advice. Do your own homework. Well, we'll keep looking at the yield curve, and if you look at it over the last 6 months, you can see that the belly of the curve is sagging a little bit. But, give or take, it appears to have stabilized in the last month, month and a half. Well, the challenge with saying it has stabilized is if you were to say, since it has stabilized, let me increase duration, think, think again. And the reason I say that is if you get rid of the March curve, and if you only look at the last 4 or 5 weeks, there was a lot of bear steepening. From September 12th through the 28th, you can see the gray line significantly is higher than the blue. And 10.8, which is just yesterday, it seems to be settling back. And so, are long-term yields going to go higher, lower? I don't know. But I'm not inclined to increase duration yet. I'm just kind of watching to see what happens. And what happens has been quite a bit indeed. I'm having a bunch of my bonds getting called. FHLBs close to 5%. They're getting called. And, if somebody paid you 5% for 5 years, that is state tax free, you will scream and take it. And so the government says, hey, that's too good a yield. Let me call it back. I also got what is a 15-year bond, which is a municipal bond at 5% getting called. And I'm like, please, please call. I'm totally fine. I do buy some of these bonds specifically with the hope that it will get called because I get par value and I always buy under par. Here is another thing that happened. I got a tender offer that I participated in. I thought I would share my joy with you. Now, what is a tender offer? A tender offer is just another kind of buyback. Now, when a share price is depressed, the company can say, we are going to buy our own shares because we are undervalued. And so they would go out and buy their own shares. And some people do it for different reasons. But the genuine reason, if somebody were to do it, would be to say, when the price is depressed, we might as well buy more of our shares and take some equity off the table. So our earnings per share would be higher because there are fewer shares trading. Well, what would you do if you operate on a lot of debt? Let's say that you issue debt that originally traded at a par value of 100, and now in the market it is trading at 88. It is in a severe discount. You, as the issuer of the debt, are allowed to do what's called a tender offer. You can say, hey, you can hold on to the 88 and 15 years later or 20 years later it will become 100, or I'll buy it from you at 90 today. You get to juice up your returns by a couple of extra points. What do you think? That's the tender offer. It's not mandatory. They invite people to participate. And here is such a tender offer. The name of the company is Centerpoint Energy. The ticker is CNP. The QSIP is shown on the screen. I got a little notification saying this company has a tender offer. And as you can see, their bond was trading at 88 something dollars. It matures in 2044. Remember, I said I have some corporates, that 9% corporate allocation that is way off on the deep end in terms of duration. Well, that is what that is. And now that company is saying, oh, it is trading way below, and we can carry that debt for the next 20 years and keep paying you 4.5%. But we see that interest rates are coming down. We want to manage our debt. So we're thinking we'll just go buy this. And here is the interesting part. They don't have to buy it at par value. Instead of paying 100, they're saying we got a little bit of cash on hand. Why don't we pay you something north of 90? And if you participate, we'll pay you something not a 90, and you get your money back. You don't have the risk of 20 more years of who knows what will happen to Centerpoint Energy. We don't have to keep it on our books, and maybe we reissue it at a lower date. It's that win-win that they propose. And here is, you can see Centerpoint trades kind of at that, it used to trade at a much more healthy point. It used to trade at 100 even on one day. This was issued in 2014, so you don't see some of the years before then. But in the last few years, it has traded right at around 85, 88, something like that. And along comes Centerpoint and says, hey, you know what? If you participate in this tender offer, we will give you $30 for every $1,000 as a thank you. And you're there going, woo, I bought it at 88. You're going to buy it back from me at 90, 90 and a half. And you're going to give me a $3 thank you for every $100 or $30 for every $1,000. This is rather sweet. That's what I said. I called Schwab and said, take it from me, and I will indeed give it to you. And that informed me a lot. So what I'm doing is I look for investment grade corporate bonds, but they have to pay me much more than the 10-year treasury plus state tax. Because if the 10-year treasury is trading at 4%, but it's state tax free, Illinois state tax is 5%, give or take, then the 10-year investment grade corporate bond has to pay at least 4.5% in coupons. However, I would like for it to also trade well below par, like what we saw with Centerpoint Energy. And if it is callable, I like it even better. And so I have a filter that says, give me bonds where the coupon is 4.7% or more. Look at this yield to maturity, 5.6% or more, meaning give me those that are trading well below par, but still are investment grade. These days, I don't find too many matches. I bought Centerpoint about a month and a half ago, and I'll make a very nice yield on it. Thank you, Centerpoint. So that is my strategy on corporate bonds. I do wait on muni bonds, and I buy them only if they match a different category. If it is a 10-year duration left on the muni bond, I look for a coupon more than 4.25%. Now realize that is federal tax free, so you would have to divide it by 1 minus your federal tax rate. And if it is 20 years, I look for an even bigger yield. Bottom line is I look for huge premiums on the treasury, before I go off the treasury into either corporate bonds or muni bonds, and that has worked well for me. Well, if nothing matches, then I just renew short term. I don't like the returns on short term, but I'm better off waiting for the right corporate or the right muni. At least that is how I think, and I sit and wait. Now, while I do that on the fixed income side, let me tell you what I'm doing on my 4.5-ish% on the equity side. You may remember there's been a lot of news about OpenAI and Oracle and NVIDIA trading money. And I want to give credit where it's due. Mr. Ryan Lamond or Dr. Ryan Lamond said, hey, OpenAI is giving money to Oracle, which uses the money to buy NVIDIA chips, which then turns around and gives the investment to OpenAI. This is Mickey Mouse. What is going on? It looks like we are inventing money out of thin air, and the valuation for all three companies are going up. Dr. Lamond, I think you are right. I agree with what you're saying, but somebody else said it even more poetically, and this was Thomas Sinow. Thomas Sinow expressed the OpenAI, NVIDIA, and Oracle deal with a lot more flair. I'm going to play a little video for you. Here you go. I'll let you make your own inferences. The fact that OpenAI would give money to Oracle, which gives money to NVIDIA, which gives money back to OpenAI, sounds a little too fancy to me. What do I know? I'm not a wealth management advisor. So I come back to my algorithm. My algorithm is based on a premise. The premise is something like this. How much is that house on that hill, or the valley in this case, worth? And you could sit here and say, well, it can't be worth a lot. We need to look at fundamentals. How far do you need to go for the nearest grocery store? And is there a hospital? And what's the school district? You can come up with all of these parameters. Or you can ask 1,000 people. If 1,000 people said that house is worth $1 million, I don't care that it is not near a hospital. It's worth whatever amount the 1,000 people said. In other words, if there is a consensus on the worth of a stock or a house, then that is the going price. If next month there is consensus that the house is worth more or the equity is worth more, who am I to say 1,000 people are wrong? I will be the blind following the blind. That is what I am doing in equity trading. But instead of just saying I'll buy anything where everybody agrees on the price, I use a couple of filters. I still use fundamentals, as you know. I have my two filters. The first is to look at companies with low debt, fast growth, high market cap, high volume. The second is the simple, is the company growing slower than its stock price? In which case I can argue that, hey, the revenue is growing faster, stock price has not yet caught up, and there is something here. If it matches both of those criteria, then my quest is to write the algorithm. So EME is MCore, and you can see that the price is taking off at the end of September into October. And what I'm looking to do is capture an early signal that the price is accelerating. If I can capture that, this is like the house on the hill, suddenly people believing it is worth more. I use something called the MACD, and you can see that the MACD intersects the signal and goes in the other direction. And this is the histogram, which is positive. And so if I can detect that the MACD crosses over, which happens at the bottom of that curve, I can then trade on that day and start accumulating stock until MACD reverses, in which case I would have a stop limit to dump it. It's that simple. If everybody in this window says the house on the hill is worth more, it's worth even more, it's worth even more, I can ride along this curve and I would keep setting stop limits. So if it starts coming down, I would be capped in terms of my losses at somewhere over here, so I can still capture this gain. That is the secret to my 10%. Now I've expressed this in Excel by creating standard deviations of the histogram, by allowing for a decay factor to create the exponential moving averages. and I look for price increases. And using that same example, EME, how can I find out the exact point where it tips? And I've been able to express that as a formula as well. So I can literally detect the day where it goes from sell less, which is the red bar, to crossover buy, which is, hey, right now we're good to go. We should start accumulating, to buy more, buy more, buy more, buy more. And so the moment I see crossover buy in my algorithm, I start accumulating stock and I keep buying until the buy more either becomes a buy less or it becomes a crossover sell. Because I have stop limits, as the price starts appreciating from 644 to 53 to 63 to 680, if it were to make a UE and go in the opposite direction, I bought it at 644, I would continuously increase my stop limits. So I immediately sell if the price were to drop to, an example, 670. So if the price were to drop by a number that I fix, then I sell. If the price were to keep climbing and I were to keep getting buy more signals, I keep buying. That is all there is to the algorithm. And the crossover buy is what I watch. You can see I go nuts creating all of these stop limits because I don't want to miss out when the price indeed drops. It creates a whole bunch of trades for me. The stop losses both capture my gains and my losses. And as long as the green bubbles are bigger than the red bubbles, I'm making money. And as you can tell, if my returns are 10.8%, the green bubbles are on average 10, 11% bigger than the red bubbles in total area. So that works out for me. I'm still working through a couple of kinks in the algorithm. Once I get to a point where I can surface up an interface that you can upload your own equities and you can get recommendations, I will make it available. I do have expenses that are minimal, but the expenses are still there. I'll have to think through how to make it available. But if you day trade and you only use one equity, you can do it on a screen. If you use 5 equities, you can do it on 5 screens. I trade 100 equities for that 4% of my portfolio, and I use the algorithm to help me manage it. And so far, it's been doing well. Barring the automated trades, you can see that, I have Planet Labs, that is my best performer. And then I have Hecla Mining and MU and so on. All of these have a couple of things in common. These all still have low debt. Their revenues are growing. And I just let the market do its job in terms of sell points, but I keep buying. I have duds, but the duds also get thrown out using stop limits. So if I lose more than X%, my algorithm automatically sells it. So I only keep the winners and eliminate the losers, and over time it self-corrects. Well, hope to reach a point where I can share the algorithm with you. At the moment, it's delivering good results, and thank you for watching Yield Nerd.